Okay, welcome back to Accounting 101. In this video, we are going to go over the solutions for these assignments at the end of Chapter 7, Internal Control and Cash. Uh, let's see here. Review questions 1, 5, 7, and 14. 1. What is internal control? Well, internal control is the organizational plan or process and all the related measures adopted by a business to safeguard its asset, encourage employees to follow company policies, promote operational efficiencies, and to ensure accurate and reliable accounting records. Another way to put it, as far as we're concerned, we want to concentrate on the first character, the first, they give us 4 things in that definition. We want to concentrate on the first one, the safeguarding of the assets, and the last one, ensuring the integrity of the financial reporting system. So another way we could say this for our purposes would be that internal control is a system that is put in place, designed and implemented in order to prevent and detect errors and irregularities from occurring. Errors are just simple mistakes. Everybody makes them. That's why we have erasers and whiteout and the delete and backspace button on the computer keyboard. Irregularities are intentional. That means somebody is trying to defraud or steal things from the business. In this case, Chapter 7, cash. And if they have access to the accounting records, one of the premises you read about in the internal control procedures would be the separation of duties. Don't allow anyone to have access to assets and access to the accounting records, because if they do, they can steal the assets and use the accounting system to cover up the theft. Okay. 5. What is the separation of duties? Separation of duties limits frauds and promotes the accuracy of the accounting records by dividing responsibility between 2 or more people. Basic tenet is don't let one individual handle anything in its entirety from beginning to end. Split it up somewhere, and when you have 2 people involved, there's less likely a chance. The first person knows the second person's going to be watching what they tell them, what they transfer to them, what they do. And if both people know that there's going to be a supervisory review, they are going to be on their toes and do what they're supposed to be doing. Okay. What else is there? Basically, the textbook says you want to separate operating functions from the accounting function and separate custody of assets from the accounting system. Again, don't let the same person who don't let one individual write the checks, handle the bank deposits, and also reconcile the bank account. You do that, it's like putting the wolf in charge in the hen house. Do whatever they want. They can divert deposits. They can do certain things with the bank reconciliation. Okay. 7. What are some limitations of internal control? Well, you don't want to spend more time and money on designing and implementing a system of internal control that is greater than the cost of the assets or the information you're trying to safeguard. Okay. In my face-to-face classes, I say, let's take 2 mining operations. One mining gold or diamonds. The other one is mining gravel. A handful of diamonds or gold, it would be thousands of dollars. A handful of gravel would be, 2 or 3 cents. Last time I had gravel delivered here to the house, I have 3 driveways. One is gravel and it's on a hill, it gets washed out. So I'm always getting modified 2B, 2A, 2, I forget. And I think it was like about $7 a ton. It cost me more for the delivery charge than it was for the 20 tons of gravel. Obviously, gold and diamonds would require a lot more controls, a lot stricter controls than gravel would. okay, because of the relative cost of the materials. Um, Collusion can overcome uh, internal controls. Again, the separation of duties is a good thing, but it can be circumvented if the two or more people that you separate the duties among work together to or conspire together to circumvent the controls. Okay, the company also needs to monitor the controls to make sure that the employees are uh, abiding by and obeying, adhering to the standard operating procedures as defined in the internal control system manual, what have you. Over time, people become lax and controls are not followed. So, not necessarily means you're going to have fraud, but it increases the likelihood that it may happen, or that if it does happen, you're not going to catch it in time. And I've got to turn the page here on this wonderful e-text. So bear with me. Okay, I just have to scroll down the page. 14, what are some of the common controls with a bank account? Well, authorized signature card. Only certain people are authorized to sign the checks. Okay. Another one would be the deposit tickets, the date and number, so you can match them up, reconcile them with what's on the monthly bank statement. The checks themselves are pre-numbered. Actually, I did run across in my prior career a place where right when computers were coming into vogue, this company bought a computer system with a accounting package in it, and they sold them blank checks where the computer would write the name of the company, name of the bank number, the bank routing number, the bank account number, and the name of the company, and also number of the checks. When I opened up the boxes, I saw that there were no numbers on the checks. I asked about it. They said, "Oh, the computer does that." Well, if somebody's operating the computer, they can write two checks with the same number, or mess around with the numbers. Don't have them run sequentially, which makes it more difficult to do the bank reconciliation when you're looking at the outstanding checks. And if you make it more difficult, people might raise their hands up in disgust and not do it. And all of a sudden, you have a major control deficiency. People not following the prescribed methods. So again, the bank statement itself and the bank reconciliation. Bank statement says is independent party, the bank. They have no reason, no interest to change anything other than what they're aware of, what's been reported to them as far as deposit amounts and check amounts. Okay, short exercises 1 through 4. Let me scroll down. Wrong thing there. And I've got to turn the page now, so let's hold our breath. It says short exercises, but it's not going there yet. Come on. Hey, second try, I got it. Okay, what do we have here? Short exercises 1 through 4. So short exercise 1. Defining internal control, our learning objective ones. Internal controls are designed to safeguard assets, encourage employees to follow company policies, promote operational efficiencies, and ensure the accuracy of the accounting records. Okay. So which one of these do you think is most important? Well, that's like asking a parent which one of their children is their favorite child. Probably safeguarding assets, because without assets or safeguarding them, the business wouldn't be able to survive very long. Assets are what give the business the ability to generate revenues. Yeah. Think inventories, right? Think cash. Those things aren't controlled very well. They're going to disappear. And before you know it, you don't have any assets. You're out of business. Okay. Problem number 2, what objective do you think internal controls must accomplish for the business to survive? Again, probably protecting the assets. Otherwise, it's throwing away resources, operating inefficiently, And if you allow that to continue, before you know it, everything is gone, or you're severely limited in what you have to generate revenues with, conduct business. If they fail to safeguard assets, especially ones like most of its liquid assets, the current assets, they will quickly slip away. Like I said, with the building, I've never heard of a building being stolen, but boy, I have plenty of examples of articles where people have stolen cash and inventory. Okay. 2, applying internal controls over cash receipts. Sandra Christoph sells furniture from McKinney Furniture. Christoph is having financial problems and takes $650 that now it went down too far. Doesn't respond or over responds. Sandra Christoph sells furniture for McKinney Furniture Company. Christoph is having financial problems and takes $650 that she received from a customer. She rang up the sale through the cash register. What will alert Megan McKinney, the controller, that something is wrong? Well, when the controller compares the sales report with the cash sales from the cash register, there'll be a discrepancy. Okay, that's why you have this independent third party or second party looking and reconciling. See, what did we sell, and what does the cash register say? If you sold a $650 couch, there should be a $650 in the cash register and on the deposit ticket. If it's not there, you say, Houston, we have a problem, or uh-oh, and then you look into it. Again, internal control should prevent it. In this case, it didn't prevent it, but it will detect it. And the thing is, if you detect it soon enough, the sooner you detect it, the better chance you have of resolving it quickly. Stopping theft, stop it at the $650 level and not the $20,000 or $50,000 level. 3, applying internal controls over cash by mail. Review the internal controls over cash receipts by mail presented in the chapter. Exactly what is accomplished in the final step in the process performed by the controller. And that's that little figurine where it shows the cash coming into the mailroom. It goes up to the treasurer's office. The deposit ticket is prepared, and it's taken and deposited in the bank. And then that is forwarded to the controller's office. The lower part of that diagram is rooted in the remittance advices that came in with the checks. The checks and the cash go to the treasurer. The remittance advices, the record of the payment by customer, goes to the accounting department so they can post it to the receivables, and that gets forwarded to the controller. The controller then reconciles those two amounts. If the remittances document the $3,500 coming in from 10 different customers, we want to see a $3,500 deposit into the bank account corresponding to those collections that occurred on that day. Okay. The controller compares the bank deposit and the debit to cash in the general ledger, the cash account in general ledger, to ensure they agree and indicate that all cash receipts are safe, fully deposited in the bank quickly, and that the accounting records are correspondingly up to date, that there's no lag in time. You do them simultaneously with the upper department, the treasury department, and the lower department, the accounting department, doing things as they occur on Monday, Tuesday, or Wednesday. You don't wait until Friday to post Monday, Tuesday, Wednesday, and Thursday's receipts. Some companies may do it, but that's not the best way to do it, because then if it's missing, it's 5 days or 4 days before you realize that there's a problem, and by that time, maybe the employee retired or took off for parts unknown. Good luck trying to catch up with them. And finally, number 4, short exercise number 4. A purchasing agent for Franklin Office Supplies receives the goods that he purchases and also approves payment for the goods. Now, obviously, here we have a breakdown, or we don't have a segregation of duties. Those 3 functions should be done by 3 different people. Or if you're a small organization, and this is what happens in small organizations, you don't have enough people to do a proper segregation or separation of duties. Well, in that case, you can let one person do it, but make sure that one or two other people supervise or authorize what this uh, purchasing agent is doing. Okay, how could this purchasing agent cheat the company? Um, he could buy goods and have them sent to his house, and or if he has a side business, or sell them out of the trunk of his car. And the purchasing agent could be in collusion with a vendor and purposely overpay a purchase order and split the difference with the approve the payment and split the difference, the excess, with the vendor or supplier. Two, how could Franklin avoid this internal control weakness? Um, the person who prepares the purchase order should not do the receiving report, nor should they approve the payment. Okay, those functions are a little bit uh, uh, at odds with one another. A perfect example, simple example of separation of duties going a long way in preventing uh, a purchasing agent from ripping the business off. Okay, exercises 13, 21, and 22. Um, Gotta turn the page here. Hey, nope, went 2 pages. Ah, yeah. Exercises, okay. Just got to get to exercise 13. Um, oh, come on. Just flipped out of there. Oops. 13. Identifying internal controls. So they give us a couple bullets there with different types of internal control procedures, assignment or aspects, characteristics. Assignment of responsibility, separation of duties, audits, electronic devices, other, and it says specify if it's other. And then they give us a few instances. A, while reviewing the records of Quality Pharmacy, you find that the same employee order merchandise and approves invoices for payment. Well, that's similar to what we just saw. Um, and that would be a breakdown in can't find it there. Don't have it. Again, that's a violation of the separation of duties there. Okay. So B, business is slow. You shouldn't have the same person ordering it and approving payment. Two different functions. B, business is slow at Amazing Amusement Parks on Tuesday, Wednesday, and Thursday nights. To reduce expenses, the business decides not to use a ticket taker on those nights. The ticket seller, cashier, is told to keep the tickets as a record of the number sold. All right, so you have two duties vested in one person, again, separation of duties. They could let their friends go in and ride free, right? Very rarely would it be able to oversell tickets and not give, or you could, yeah, I guess they could take money from the customers and not give them the tickets, just take the money. And then when you reconcile the number, the cash coming in, let's say it's an all evening pass for $10 and you sell 50 of them, but you take an extra two, that'd be $70, but you only issue or you keep the tickets. There's no way to reconcile to know how many tickets were sold if you have one person keeping the tickets. When the person buys the ticket, you should give them the ticket, and at the end of the night, you know how many tickets you had, less how many you sold. That would equal the number of $10 bills you collected. You'd reconcile it. Now, C, the same trusted employee has served as cashier for 12 years. Eh, you got to be again, when somebody does something for a long period of time, you tend to build up a lot of trust. That doesn't mean that trust is that there's a deserving of all that trust. The problem there is what happens. You should have somebody that has a can act in that function and rotate that function in and out. What happens when that longtime cashier employee, the 12-year employee, gets sick or takes some vacation time? Who covers for them? Do they let all the work pile up on their desk for a week and then they handle it when they come back? By switching people around among tasks, especially something sensitive like a cashier, and do it on a random basis, then you keep that person on their toes, because if somebody was committing fraud and they know somebody's going to come in and do the job tomorrow or next week one day, they're going to notice that discrepancy, or if there is a discrepancy, they'll notice it. So it sort of have, if they know somebody's coming in to look at what they've been doing, they are more apt not to do something bad. D, when a business is brisk, fast market deposits cash in the bank several times during the day. The manager at one store wants to reduce the time employees spend delivering cash to the bank, so he starts a new policy. Cash will build up over weekends, and the total will be deposited on Monday. Well, that puts you at more risk. If there is a break-in or a holdup during business hours, you have more money on site to lose. So you want to minimize the amount of cash on hand, put it in the bank. Bank's insured. The bank is more well protected. Yeah, banks get held up, but then it's the responsibility of the bank. The bank is insured for things like that. Hopefully your business is insured. But again, don't even give the criminal the temptation. Somebody sees, you see a lot of cash laying around the place, or they know that there's a lot of cash in there. One of the employees are talking, oh, we don't deposit every day anymore. Somebody's gonna go in there on Sunday or Monday before they go to the bank, before they open, and they're going to get several thousand instead of several hundred. So again, minimize your loss, mitigate risk exposure. E, grocery stores such as convenience market and natural foods purchase most merchandise from a few suppliers. At another grocery store, the manager decides to reduce paperwork. He eliminates the requirement that the receiving department prepare a receiving report listing the goods actually received from the supplier. Bad idea. Yeah, you could say, hey, this is a function that takes employees time to do, but it's very important. How do you know what you're buying? How do you know what you're getting? How do you know what you're ordering? How do you know what you ordered is delivered if you don't do a receiving report? And you don't. Somebody could say, yeah, the people, hey, we don't have to do a receiving report anymore. Somebody in the receiving department, hey, we don't have to do this report. I'm going to take a case of eggs. I'm going to take a carton of cigarettes. I'm going to take whatever. I'm going to take a couple of lobsters or a couple of steaks. And nobody would ever know because, hey, it was ordered, but we never got we stopped doing our receiving report. So it's not here, it must be sold. Well, after a while, if that theft keeps mounting, you're going to see your gross profit percentage drop. That's where financial ratios come in to play. All right, what do we have? 21 and 22. All right, good old bank reconciliation. Let me get my form handy. And then we've got to get over to the exercise itself. Please bear with me while I try to turn pages electronically. Okay, 21. 18. 20. 21. Preparing a bank reconciliation. Hardy Photography's checkbook lists the following, and you have it there. They have the date for November, the checks that were written, and 2 deposits I see there. Underneath that, in the beige or light yellow box, they have the bank statement. Okay, and it shows the balance, beginning top, and what the bank reported, and then the ending balance. So the requirement here is prepare the bank reconciliation for the end of November. So let's set this up. They tell us, here's the blank form. I don't know if I sent this out. I'll send them out if I haven't. Yeah, I probably haven't. So balance per bank, and they are telling us the bank is saying we have a balance of $302. So again, you have this column, this side, the left side for the bank, right side is what we call balance per books. This is the company's thing. And we have add on both sides and less on both sides. So like hopefully I did in the lecture video, it's two questions you have to ask yourself when they give us this information, or when we hunt for the information. Ask ourselves which party is aware of that information. If the bank is aware of the information, then the adjustment has to be done on the company, the book side. If the company or the book side is aware of the information, the adjustment has to be on the bank side. And then all we have to do is determine, well, was that increase or decrease the bank balance? And then you either add it or subtract it. It really is that easy. Okay. So let's take a look here at what we did. And wouldn't you know, they just make it so I can't see both of them. And now I got it just about right. So the balance in the cash account checkbook at the end of the month is